Gotta unmute that. Cool. All right. Where are the weirdos? What's up, guys? How you doing? Hey, Billy Goat Jenkin. And today was wild, huh? Are you serious? All right, fine. Gaming, dick. This whole week has been grindy. There's a reason for that. The the market currently is extremely data sensitive, and we've had data every day, and so we keep getting like event vol on the one DTE priced up, and then nothing fucking happens, and so everybody just short strangles the fuck out of all the options, and we trade flat unless someone gets squeezed, which happened twice today. We squeezed both to the downside and the upside of oversold options positions, which was that was fun. I had a good time with it. Just wait for everyone to get in here, I guess. How the fuck do I share this thing? All right. I don't give a shit if you're making dinner. Get your ass in here. All right. Who wants to ask a question? Oh, shit. Zoots.
Yeah,
Hey, what's up, man? How you doing?
what's going on? I'm good. How you doing?
Hanging in there.
All right, nice. I have a bunch of questions about Vana.
Oh,
Um,
fun.
yeah. First questions are like, do like the higher nodes of positive Vana act as a magnet versus negative Vana acting as like the opposite of that? And if so, like I should be paying like I noticed that when price is trading like at spot, Vana's at the lowest, I think. So like the what my like I'm trying to really wrap my head around it because again like I trade normally like intraday and nothing long term, and I also noticed that my other question is, are the Vana effects opposite if price is trading above or below Vega neutral?
No, no. Um,
Okay,
so
so it doesn't.
so Vana is not Vega. Vana is the change in delta relative to the change in implied volatility. So basically, what Vana is telling you is it's telling you about the shape of the delta curve
Yeah, the in
with.
short, right?
Uh,
If IV goes up or down, right, how does it spread out that S curve of delta?
yeah.
Okay. But if I see a lot of positive Vana above spot and price, or let's just say above and below spot, there's a lot of positive Vana, and IV is low. Does that act as a tailwind and help support price?
Wait, hold on. Can you repeat that for me?
Yeah, if I see a lot of positive Vana below, above and below spot, and price and let's just say IV is low, right?
Okay.
Um, does that lead? Is that a tailwind? Does that lead to just more supportive flows?
Hmm.
It depends if IV goes up or not, right?
Yeah, it's going to depend on the change in volatility at spot. Um, like if spot vol moves up into end of day anyway, so there's some slight pressure from Vana on delta into close. Like Vana is pushing delta up at spot into close because IV is going to be rising at that level. But I guess if you're yeah, I mean yes. As generally Vana flows are something that affects like larger expirations though. Like zero
Okay.
DTE Vana flows, I don't think are really nearly as impactful as like charm. They can be if volatility moves a lot into the end of day, but generally speaking, if volatility is moving that much into end of day, spot is also moving a lot. And so the change, I mean, remember Vana is a third order derivative of delta. So its effect on delta is minimal, generally speaking. And then, delta's the big boy. And when you're dealing with like end of day flows, the change in delta is drastically more significant than the change in delta due to Vana. So like delta v spot, is far more important than delta and Vana.
Well, so yeah, like I think once like kind of comes back to you have to sort of imagine uh delta. I guess you could just think of gamma, right, like as like a proxy for a bell curve. And Vana sort of describes how that bell curve widens. And when we think of zero DTEs, the bell curve on zero DTEs is much, much narrower than things that are, further out expiries. So, in terms of sensitivity to that widening, right? If you just think about this from a gambler's perspective, right? The further away stuff, and I don't mean that derogatorily, like the further away stuff, right, has a much higher chance of changing its probability than the stuff that's about to expire, right? So what Girk's getting at is that, yeah, the further away something is from expiring, like let's say it's 5% out of the money and it's 30 days out, right? That has a lot of opportunity to change its likelihood of closing in the money or expiring in the money. So the Vana on that contract is going to be much, much higher than the Vana on a contract that's even 1% out of the money on a 0 DTE. So, yeah, just something to consider.
Got it. Yeah, I mean, I'm just trying to like think of it like when I do my pre-market prep and everything else. I have my delta levels, and I look for spots of high delta or low delta, and my gamma, of course. And then I get an idea of like, okay, price might pin in this area, whatever it is. But I was just trying to see how I can add or incorporate Vana, like when it comes to that, to kind of like maybe add another layer, or kind of give myself like some perspective of like how things could work, or let's just say what price might do if IV does rise, right?
So yeah, so Vana, I think in terms of understanding what can happen, it's primarily, I think, important on days where there's intraday data happening. So, like, let's say FOMC rate decision day, things like that, where volatility is going to change drastically, are where that derivative is more important than, say, just a humdrum day with nothing going on, right? Because the likelihood of volatility increasing is much, much lower when there's nothing going on. It takes something to change the probabilities in the market. And so absent of a known change in the probabilities in the market, I mean, there's not much you can really glean from it. So that's kind of one of those things. I mean, you can look at it and say, okay, if something crazy happens and the odds shift, then this will be important. But without knowing when that's going to be, right, it's kind of pointless. It's an exercise to do, but not much more. But on days where there's data intraday, it becomes more significant.
Yeah, so it's either that, and then like you guys mentioned earlier, in combination with charm towards the end of the day, it could have a higher impact. Or let's just say it's the week of OPEX or something like that, right?
It could have a lot of impact near the money.
Okay, but also like the end of the day or the end of the week, would Vana have a higher impact than earlier in the week, let's say, assuming that there's no
Yeah, I mean
events that we can't account for.
Friday expiries are a little bigger, but outside of OPEX, I mean, they're generally not huge unless it's like end of month also falls on a Friday. In which case they can be really significant because like the SPXW chain's largest expiration is generally the end of month expiration, and the SPX monthly chain, the largest is OPEX. Even though end of month is generally significantly smaller than OPEX, it can be big enough that Vana flows matter going into end of month. But I would say you need to think of Vana as more. It's not like a hard anchor for spot price the way like Gamma or Delta will act. It is like drift. And not even just drift, like multivariate drift. Like there's a bunch of conditions need to generally be satisfied for Vana to start to become important. Um and obviously the root of that is change in implied volatility. So I kind of drew you a little thing here. I don't know, can you see it?
Yeah.
Let me make sure that they can see it over on the stream too. Sorry. Oh, there we go. Okay. So this is kind of like how the end of day was set up today. In that, like, IV, like, say this was like the 55, or, well, I guess like 50 strike, and this was like the 45, and we were kind of chopping down here for like ever, right? We're just
Yeah,
in
I
this
remember.
range, and IV wasn't really doing anything. But that end of day, like, IV shifted up. People started buying really heavy the out of the money option. And when that IV shifts up, this Vana affects that underlying delta, right? And that the delta in those strikes starts to rise. And then as spot moves up, the IV on those calls moves up. And then Vana has more of an effect. So the more you move up the IV curve, if you're watching, the points on the IV curve, and you see like spots here, and then you see, this one move up. So you had that curve, and now you're seeing it shift, right? Higher. Then, IV at spot is also climbing. So Vana's going to start to affect that. And then as price moves towards that, Vana's going to pick up even more. And the underlying delta is going to move like almost like pushing up a wave, kind of. So like, you have like a wave, right? And then the Vana acts as a force to push that up, and that wave is the delta. And so if you can kind of think about it like that, then Vana starts to have an increasing effect on price action as price continues higher. And so that's like why the squeeze triggered, is because we crossed that strike where IV really spiked, right? And then all of that negative delta suddenly moves rapidly positive. And then, you have some other effects there too, because it's end of day. So, the delta on a contract basically is going from like 0 to 1 instantaneously, which requires like extremely strong hedging flows. But, Vana is a big part of those hedging flows because of that change in IV. So I think we had like I think it was like the out of the money strike under spot was like 25.3% IV. And then the 50 strike was like 35.4. And as this kept climbing and this kept dropping, so sold puts, bought calls, this kept moving up. And then in between there is spot, right? And so even though spot was static, the IV at spot continued to rise, which took the delta, which was at spot, which was negative, and started to push it positive because of the Vana.
Got it. So I guess I felt wrong because I was thinking that the positive, like if IV is rising into positive Vana, like it can just keep like the delta, it's increasing the delta, which leads to potentially which leads to more hedging from the market makers, which can
Yeah.
lead to more buying.
That's what
From,
you're.
from,
No, you got it right. That's what you're seeing.
That sounds
okay.
almost like a Vana squeeze.
Yeah, I mean, well, it's a
it,
couple different things at the end of the day like that, but yeah, speed and Vana, and they all
and
they all
it,
have a impact.
right. If it just quickly, if Vana happened to be negative, a couple like that 55, let's say, or the 60 or 65 strike. I mean, maybe this isn't the best example, but would the effect be different if IV was rising
Well,
So
versus
think about
negative
it.
Vana's
Vana above
usually just
spot?
negative at spot.
Well, let me just give you the intuition here. So positive Vana means if IV goes up, delta will go up. Negative Vana means if IV goes up, delta will go down on that strike, right? So just to give you the intuition behind the bars you're looking at, that's pretty much how they work. So if you see negative Vana on a strike, that means that if IV goes up, its delta will go down.
I see. Got it. And then depending on what I determined, what my assumptions are on in regards to the bought soldness of that the options at that strike, I can go ahead and figure out, okay, how is that affecting the market maker's hedge now, if the delta is there, if the delta at that strike is decreasing.
Wait, say it for me again one more time. I didn't quite hear that. I'm managing
No,
some broccoli.
no problem. No, what I was I was just saying that if I would need to go ahead and see what strikes. I would need, based on my assumptions, if I think a strike is either bought or sold, right, and I see that price, let's just say there's negative VANA below spot and implied volatility is increasing. So what you said was that delta now would be decreasing. So depending on what I think in regards to the bought soldness of those strikes, I can go ahead and make I can go ahead and determine what will happen to the market maker's hedge based on the delta decreasing.
Yeah, that's a good way to put it. Yeah, so we make the assumption when we do these that we just assume an extreme greedy market, basically.
Sure.
So yeah, with your assumptions, yeah, you could come up with something like that. It definitely what you want to do though, like if you're trying to make aggregate, aggregate sort of conclusions about this, you do really need to kind of think about everything all added up rather than just single strikes, unless you're trying to play that strike in particular, which can be done. I've done it a couple times successfully, where you see something like that and you try to take advantage of what's going to happen to the price of the contract. But usually I just try to look at the sum total of it. And for the sum total of VANA to be negative, yeah, you're pretty much in a squeeze scenario.
Yeah, it's rare. I don't really see it too often. But yeah, I mean, I think what you said really just resonated with me. It was very simple. So as IV increases, if there's positive VANA, delta increases. If there's negative VANA, delta decreases.
Pretty much. The delta hedge, right?
The delta
Yeah,
hedge.
so you could
Yeah.
you could see today actually. Sorry, I was late, but
No worries.
you could see today that actually. I mean, just looking at this chart here, a lot of the Vana, and if you want to like just zoom in on, I guess tomorrow. I have no idea what it's going to look like, but anyway, but in general, yeah. So, like, you don't even really need to make an estimate on the bot soldness below. It's all kind of washed out, and so it's probably a pretty good assumption that those calls above us are sold, and which is the assumption we're making. And so this is saying that there is positive Vana. So if IV happens to increase, the market maker will buy to offset. So in general, if IV increases, it's because there is downside risk generally, and so if you have all of this positive mana here, then they're gonna have to buy against that downside risk, and so it is advantageous for people who are trying to continue to support price by staying in a positive Vana environment. And you can just kind of see, just looking at all the candles, there's no negative, it's mostly positive. So that's very advantageous for bulls.
Yeah. And then if I happen to just notice like just a large concentration of positive Vana nodes and prices like approaching, I shouldn't really pay that much attention as opposed to gamma, right? Because that's going to have the bigger effect, right? Like let's just say there's a lot of delta and a lot of gamma. I know it's gonna, price is most likely going to be pinned there, right? But I shouldn't like look at anything as like the way I would look at a gamma ramp or like levels of high positive Vana and then low or anything like that. I'm not gonna get too far into the weeds with it because you guys mentioned like, hey, it's really not something that is gonna affect so much, except for the scenarios that we mentioned where it's
Well, yeah, I thought I heard
yeah.
earlier that you mentioned you trade zero DTEs, right? Mostly.
Yeah, I trade.
or intraday.
I trade. I mean, towards the end of the day, because options then are cheaper. I know like things are a little bit more volatile, but it's normally the last like 2 or 3 hours I'll trade SPX, and then earlier in the day I'll just trade my my Tesla and or whatever PLTR,
Okay, yeah,
AMD, all the
but if you're
tech. Yeah,
doing but if you're doing intraday trading, so like for example, bulls want volatility to crush. They're all short vol, right? And they
right.
want to use that short vol position to kind of coast us upwards gently without any big surprises. So when you're looking at Vanna, you're looking at like the element of unexpected surprise. So in a way, I haven't quite figured out myself how useful it is in a predictive sense because it really only matters if something unexpected happens. So like today, it looked like my best guess, I'll have to go back through and dig deeper, but my best guess of that big drop in the afternoon that I was busy at work, but
Yeah, I was
it
watching
looked like
that.
it looked like somebody was just rolling some really huge like sold put position or something. I don't know. I'm speculating, but the fact that vol went way down and then went way back up, um, it's unexpected, right? There's no amount of like measuring the market that could have picked out that some random person was going to move this massive position in the
Right.
middle of the day. And but what you can note is that, oh hey, like while they're moving this position, so even if it's not a roll, even if someone's just like closing out sold puts, again, I'm speculating. Um, the market maker's still going to be buying into that
So I also want to say,
because of this
Joseph,
positive Vanna.
I just want to say something too that so I think there's the other side of what you're saying that I think matters. An unexpected increase in volatility is unlikely to happen normally. However, an expected decrease in volatility is always likely to happen on events.
Yeah, yeah.
No,
And
I agree.
Vana's also really important when volatility is trending. So when you have substantial skewness in the IV curve in the intraday, which sometimes is very noticeable. Like sometimes you just have a shitload of like downside skew and it's like the curve kind of looks like a check mark. You get a smirk instead of a smile. Um and Vana's very important in those situations, especially if that keeps like that out of the money IV continues to rise directionally. The Vana will start to become more and more significant. And then if price starts to move that way, large piles of Vana can end up being like price targets for out of the money moves. And so like Dork was saying before, on days where you have like FOMC or something like that, very frequently I will go and look at those piles of Vana and see where price action's likely to end out of the money in either direction. Because sometimes if you can catch like the crush before the move, like sometimes you get like a big crush in IV before you get a big move off of the presser, you can target those out of the money positions and those options can be really super underpriced, despite being where Vana kind of tops out and like the market maker stops hedging the change in volatility so much. And so I found them really useful for that, also on days where like environments, I guess, where volatility is just high. If you have like a shitload of volatility on the 0 DTEs because like the market's down 5 or 6% over the last like couple days, and those options are super like just super overpriced, Vana can be really good for finding where you are likely to get continuation and where that continuation is likely to end, because generally those targets will be further out of the money than what you can gather from delta and gamma alone.
Got it. Yeah, thanks. For me, what I was just thinking about is like when you guys spoke about the sell off in the afternoon, like is there anything like when I'm watching the live data and I'm seeing the live Vana, is there anything like when I see that IV has slowed down that that can now lead me to think like there might be a continuation like back to the bounce where we had that gap fill, where we had that big gap, and then it filled up.
So
But yeah,
you really need to, I mean, you need to gather a lot of information very quickly in those situations, because the first thing that anybody thinks when they start to see a big drop is, oh, was there big news? Did something
sure.
collapse? Did somebody go bankrupt? Like, did somebody announce that Microsoft lowered their quotas and then reversed it like 4 hours
Right.
later, right? So news is really important, and then the impact of that news. But in the absence of news, like today, we're just like down and up. I mean, generally in the absence of like a big shift, like when you have a day like today where it just kind of like choppy in the morning, people were repositioning, people were moving positions, and then it's sort of kind of started dying out. And then just like all of a sudden there's this random drop. And if there's a random drop and it's not news related and it's not like regime shifting, you could probably expect it's going to reverse.
Yeah, exactly. And I mean, like normally on a play like that, where you're really trying to time it. I'm sizing for zero. I'm not putting a stop loss on like the end of the day or toward the last hour, 2 hours on SPX options. So yeah, again, I appreciate everything. I think I'm gonna just go back and listen to everything you guys said. You guys
Yeah,
definitely
I'll just say
very
one
insightful.
more. I'll say one more thing
Please.
too. Like
Yeah.
and I apologize. I had to. I was watching the market this morning, but I didn't follow it super closely today. I just saw that the market dipped. God basically answered Dork's prayer and offered to get him out of his underwater put that he bought. That I told him it was going to bounce and not to buy it, and then it bounced.
Fuck you, dude.
Um,
My goddamn coworkers distracted me from that goddamn
I
thing.
know. Well, I
So
didn't even
pissed.
see it till it was over anyway. And I was just like, oh, Dork, did you get out of that put? And you're just like, yeah, shit. I was like, well, that sucks because God doesn't normally answer prayers more than once.
Yeah, we'll see what happens.
Anyway, I mean, one interesting thing to note, and I'm not even quite sure I fully understand why this happens, and maybe I never will. And maybe the point is that I'm not supposed to understand. I'm just supposed to observe that this occurs. But you can definitely see like there's weakness, but stable weakness until you get to that gamma flip, and then it just dumps. And then it just rockets right back until you get to gamma flip, and then it just hits this blanket, right? And so this is something that I think all of us have observed many times in many different scenarios, that anytime, you're showing weakness like this, like once you dip below gamma flip, there's a big chance that you can continue downwards. And then there's a big
Yeah, a
chance
lot.
that you'll rocket right back to it.
Yeah, for sure. A lot of times, what I notice, like when Gherkin has always mentioned, not every day, but a lot of times, uh, when the price hits the gamma flip the first time, it might bounce, off of it, and then it's the second time or the third time that it can like really cut through and dump. And I've seen that countless
Yeah.
times. You
I
know.
think my sense is that I think we might be getting to the point that I don't want to say that we're doing anything that is clever, because I know that there's a lot of resources and a lot of smart people that are looking at these things, but I think there's a lot more people looking at these kinds of things than we might imagine, and they are trading off of it, regardless of like what it actually means for the total positioning in the market. Most people don't understand or have insight into what the positioning is. They just know like, hey, if we get into negative gamma on zero DTEs, which are 60-70% of the volume in a day, like we should probably expect volatility. And so if you expect volatility, you might expect that people are going to put a lot of stop losses and things like that in that region. So it's one of those things where I've just sort of resigned it to be. I think a lot of people are looking at these kinds of things and trading off of it, and that's just good enough.
Yeah. Okay. Well, again, thanks, guys. I don't want to, hold up the time of anybody
No,
else that
no
wants to
problem.
go up.
You
I'm
know,
gonna
Absolutely,
go
man.
back and listen. Yeah, go.
we love to overanalyze everybody's questions for like an hour. We get through like 3 questions a night.
Yeah, good.
I mean, I feel
I
like if
really, yeah.
people are willing to take the time to come up here, we should be willing to answer the questions for them.
Yeah, I appreciate it. I'm just not gonna put like as much stock into Vana as I have, previously, and just get back to focusing on, the bread and butter, the delta and gamma, and
There's a reason we
and
named it
just
Gammastrike.
yeah. That's what really works. I just think I just thought that maybe I was missing something, or maybe I can add, something else with a better understanding of Vana. But I
I
think
no,
Dork
it's an excellent
said
question.
it best for me.
Thank you, sir, for your question.
Yeah, thank you guys. I really appreciate it. Have a
Thanks
good
for
night.
coming up, man. Have a good one. I
You too.
actually got a question for us from over 2 questions for us over on the YouTube, JFresh. So we got does Gamma Strike help me understand the interplay between space, time, and causality?
So this obviously sounds like a troll. Who wrote this question? Do I get to know? Or is
I
it
don't
is
even
it
know
double,
anybody's name on YouTube anymore because they
is it
changed.
single blind?
It's
Single blind. Okay.
yeah,
So they get to know who I am, but I don't get to know who they are.
exactly.
Ugh, the worst kind. All right. I'm assuming this is a troll question. But I'm gonna make this all about me anyway, because I'm good at doing that. There was a post I saw, like somebody on Fintos was like, "Hey, my son is in high school and is just like super into like pulling data, and like price action, like getting price candles, historical price candles, and trying to do back tests and build models and things, and like just looking for advice. And everyone had their advice to give them, yada yada yada." As somebody who's pulled a lot of price candles in their time and wasted a lot of energy looking down, trying different things to look for signals, I would say that most of the signals you're going to find doing things like Fourier transforms or in any sort of like mathematical strategy that has a name, like somebody's already tried. And so the thing that I want to kind of focus on is the causality word, because I think what's really important in markets is to try to understand who you're trading against and what their positions are, because the more you understand who they are, what their goals are, and what their as much as you can gather what their positions are, that is extremely valuable information, and it is harder information to glean, but I think ultimately much more so. So in terms of causality, I don't know that we're quite there yet, but at least for me, we've always said that we started building this tool for others when we got to the point where we couldn't sustain it ourselves. It's just got too expensive. And I was just talking to one of our devs the other day. I was like, yeah, it's kind of a slog right now. We're trying to keep customers happy. We're trying to make sure features are stable and performative. It's not as fun as like playing around with like a new theory and new things like we were doing in the early days when we were building the service and still trying to figure out what do we show people? What's the most valuable information to even show people? But this part of that cycle is really important because the costs to sustain this level of information is so high. We couldn't do it just on our own, just for fun. And so I do think that we are getting closer to basically reverse engineering the market, which is causality. It's going to take more time and obviously more data. But we're starting to get to the point where I think that some of the things that we're able to do are starting to touch on, interesting ground. So I know it's a troll question, but I want to use that as an opportunity to say I think causality in the market is really important. If you can figure out little pieces of causality, you can use that to your advantage. And it's so much more valuable than any backtest you could ever do.
Damn. And then the second, far more serious question from Gorilla Mode.
Cock?
Cock, 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 cock. Cock, 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 cock,
I've
cock,
been
cock,
I've
cock,
been
cock,
studying the
cock.
ways of the cock.
Oh, okay.
He's
Excellent.
intrigued me. I haven't really come up with many things, but I am gathering information, and I will release it when it's ready. That's currently not much to say on the cock front.
Oh damn! B-Watts has got like a whole fucking PDF and shit. This is the kind of preparation that I love to see. By the way,
Oh shit!
if anybody
Can you
wants to
hear me?
know how to make me and JFresh's life easier, not like you guys have ever tried. Yes, we can.
Oh,
This
Also,
is
hold on.
this is how you do it.
B-Watts. Is your PFP the Five Nights, the Fazbear, and a Walker? That's too big for it?
no, Squidbillies. It's the grandma and Squidbillies.
Squidbillies. Okay.
Yeah.
It's a TV show.
Do you know what Five Nights at Freddy's is?
Is that horror show? I haven't watched it. But
It's like a video
game.
game.
I haven't
It's
watched it yet.
it's
Oh,
like a
is
kid
it?
thing.
Oh,
Yeah.
oh, okay. I thought
They
it
made a
was
movie
horror
out of
movie.
it. Well, they did
Yes,
make a movie
okay.
out of it, but it's based off of a game that kids have loved for a while. I'll have to look into
Alright.
Squidbillies. I'm not from the. Oh God, 2005. Where have I been?
Yeah, showing my age. That's why it's the grandma as well. That's my internal joke. Yeah, so cool. So thank you for letting me come up here. I talked to you last time about looking at the eye, like the skew. And you said you watched like minus like the strikes around spot, like the 3 strikes around spot to see if you can see. But I don't see anything really obvious. I see little ticks up and down, and I'm not sure that's sort of the subtleties that you look for or not. And then I was sort of trying to find a good example of it, and then I found this, and I thought, I've got 3 screenshots.
Okay.
And I've got the link if anyone wants to watch it. It's about 11 minutes worth. It's this kind of nice V that happens. And I feel like there's lots of questions that I can ask with it. So
yeah, if you could share the video
yeah.
in chat, then that'd be great.
Oh, the link.
That way I can. I'm not gonna play it, but I can. Like everyone will have it. Nita, are you still jealous because you thought my butterfly wasn't gonna print? Wow. Petty.
That was funny. Okay, there's the link. Yeah, so before the V started, I just sort of made a note that there was around 4,000. So there was sort of the ad, the money puts a bit below, like 6,600. There were puts 6,6610. There was about 3,000 puts, and the put premium and the call premium were about the same.
Yeah.
But my first question is sometimes the put call ratio is higher, but the put and the call premium is about the same.
They don't move in
Okay.
line with each other because. So yeah, this one's. I know where you're going with this. It is easy to explain. The put call premium is really you're only gonna see that change if those options start to reprice. Whereas, if people are just trading those options back and forth and there's not a lot of change in the price of those options, You're not gonna see too much change on the premiums.
So, but is the premiums like the net, like, you know, if there's a 10 million worth of puts sold, is that 10 million? Or is the put premium something different? Like, I've thought of it as the net amount of basically money running through
but
puts,
if the options, but if the options are like, if it's going back and forth, you're really just not going to see any change. Even though by volume you might be getting more puts and PCR is rising, you're not really seeing a substantial change in the price of those options. Or, you know, everything's just getting chopped around spots. So they're bought, sold, bought, sold, bought, sold, bought, sold. And so the premiums on them are staying flat.
But do you determine bought sold of the calls or puts, or do you just assume calls are bought and puts are sold by the MM?
Actually, JFresh, for this one, we're using the naive assumption, right?
For this, I mean, for PCR and for the all the stuff on the bottom graph, it doesn't matter.
Yeah, I didn't think so.
It's just numbers. I mean, we're assuming that
Okay.
people can't trade negative dollars, but so it's all positive. But yeah, I had to miss a little bit of this because I had to yell at my kids. But I'm gonna assume what you were saying was if put premiums are flat and low, and your PCR goes up, that's bullish, or at least not bearish, right? Or did I get that backwards?
We've been assuming that, well, the vibe channel rather that I looked in. I thought that meant bullish when PCR rose because more puts are being sold. I don't know.
Yeah, well, that's if premiums are low, right? If put premiums aren't spiking. So you could kind of look earlier today when we had that big dump, that doomp. Put premiums spiked hard. So put call ratio spiked and put premium spiked. Which implies that they got, you know, they've been selling all day. They got a little fuckaroonied. They got a little cut off sides.
They got squeezed out hard. Yeah.
Yeah, so they squeezed. And so your PCR went up, but your premiums also went up, which is really bearish, right? And then they stopped squeezing and then boop, right back.
Yeah. Something to note here is I'm trying to think of the actual, like, because I know you're just asking about like the math behind the tool. You have a rolling window here, and so the window is flattening those premiums despite volume being traded. So like it's just not it's not enough volume being traded to show any real significant change in put call premium minute to minute as the window rolls over. And so if you actually start to get some movement, then what you're seeing is movement in excess of what has been seen in the rest of the window.
Yeah. I actually wanted to ask about that. I mean,
which is actually really useful when you're trying to determine reversals.
It is something we had a weird thing last night where there was this 1 minute window, and I think it just needed I don't understand. I think it's just something that is a bit of a bug or something, but we had different PCR ratios, like 1 minute spiked to 18, like 18 times. But then if you refreshed it, it disappeared. But I just have a question about that because I was sort of doing the maths around it. So, you know, you've got 5 minutes and then that 5 minutes, I don't know. I was trying to I'm not criticizing the system or anything. I'm just sort of, you've got 5 minutes on the 5 minute time frame. It looks like you're taking the average of the 5 minutes to get the PCR ratio for the 5 minutes.
No,
you're not adding up the net. You're not, because there was one spike of 8 or the two spikes of 18 and then it went right down, and those two spikes of 18, like it was just 1 minute of 18 and then all these minutes of it low, and then that seemed to drag up the 5 minute average.
Okay, I can answer this.
Just like kind of disproportionately drag it up, if that makes sense.
We're still kind of working through it, but specifically for the 1 minute. So the way that we're currently doing it is we are bucketing all of our data into 10-second buckets, and then we are aggregating things from those 10-second buckets. And so when you're on the 1 minute, the 1 minute will fill 6 buckets, and then when you go to the next minute, it starts filling with new 10-second buckets. And so what happens is you have a divide by zero issue. The volumes are so low, and you might have, for the first 10 seconds of that bucket, you might have like mostly puts traded and like very few calls traded for that 10 seconds. Then the put call ratio will be infinite because you're dividing by zero. And so that is, I don't want to say it's not a bug, but it is an artifact of the math of the ratio. And
But
the way that, because it is not simply an average, it is distributed into, time buckets, the way that we're doing it.
So is a
In that-
5 minute? Oh, sorry.
Oh, the 5 minute is much more stable because what happens there is we're still filling in those 10-second buckets. But for the 5 minute, what happens is we'll roll off the first minute and start filling the next minute. So there's always still something in that 5 minute window, so that you don't get that divide by zero case that happens. So usually the downside to that though is that you get slightly delayed trends, but that can be fine depending on the
They're also
time frames that you're
stronger
looking
trends,
for.
though.
Right, they're stronger. Right, that's why I said they can be fine
Yeah.
because it's a longer trend, so it's stronger. But if for whatever reason you're really looking for like super timely data, then you just have to keep in mind that once you start that new candle on the 1 minute candle, if you see a put call ratio that goes really high, just wait a couple seconds. Wait like 20 seconds and see what it looks like about 20 seconds later. And if it's still high, that could be indicative of something early on.
Which maybe we should
Otherwise,
do.
I mean, the 5 is
Maybe
kind
we
of
should
ideal.
We should do the 1 minute bucket as a 2 minute, like a functional 2 minute bucket.
Can I ask with the 5 minutes, does that mean you've got 30 buckets you're averaging over? Or are you saying that with the you got 30 buckets. Okay, so it's not
there's
1
like
minute to
macro
drag
buckets
it
and
out
micro
of
buckets.
alignment.
Yeah.
Yeah. So
There's 6
that's what I was
micro
just worried
buckets
that
to one
maybe,
macro bucket.
I was just worried maybe that a 1 minute that only had a whole lot of puts in could maybe give us a false flag or something. Do you know what I mean? By dragging the other 4 minutes
yeah.
up.
Yeah, it does.
Oh, it does. So it's not
No,
an average of the 30 buckets?
Sorry, no. On the 1 minute it does, but on the 5
On the
minute
1 minute
it
does, yeah,
usually
okay.
doesn't. Yeah.
Yeah.
On the 5 minute usually behaves a lot
Because
better.
the 1 minute
you're
goes the 1 minute goes to zero at the end of every minute.
Yes. Yeah.
Whereas the all the other windows are just rolling over 1 minute at the start of every new minute. So you're maintaining, a 4 minute trend or a 15-minute trend or a 30-minute or 29-minute trend, 14-minute trend. And then,
Yeah, and
bucket 1 falls off, new bucket starts. But on the 1 minute, it just just snaps to zero at the end of every minute.
And you might be asking, like, why do we do it this way? Why it seems more complicated? Is there another way to do it? It really is. Once you get under 5 minutes, providing information that isn't just crazy noise is difficult to do. Okay. And so we're trying to find that balance at the 1 minute. And I don't know that we've dialed it in perfectly, but we are
that
trying
makes sense.
to.
I was just worried that the 5 minute might be the average of the 5 minutes, not the average of the 30 buckets. And then I thought that like a quiet minute that was just full of puts might kind of throw me.
No. It's all yeah. So each micro bucket is 10 seconds, and so if you have the 5 minute, you have 30 micro buckets, every new minute you throw out 6 of them and start filling the next 6. So you still have 24 there, kind of anchoring everything.
Yeah. Yeah. Okay. Thanks. Yeah. Sorry, I didn't mean to drill you about the markets. I just
No,
sort of,
I think
saw
that's
something
fair, right?
spike and I went, "What was that?" And it kind of threw me. So
No,
it just
that's
occurred to me
perfectly
maybe the
fair
maths
question.
wasn't. Yeah.
The
So
math is correct. Yeah, so it's not really a bug, it's just an artifact of the
yeah,
division.
yeah,
Thank
and data dropping off and everything.
thank you for the Ko-Fi, whoever just sent that. Yeah, so I mean, there's probably a few different ways that we can smooth out the 1 minute bucket so it's not so random. But the 1 minute bucket can actually be really useful in itself. The fact that it zeros can be useful because you can measure kind of like the height of the pulses versus each other and see what's happened over like the last like 5 candles. Because it zeros out every time, you can kind of use that like the wave height on each 1 minute signal to kind of determine mentally. You can kind of smooth it out mentally and determine what's being positioned there and what's going on.
Yeah,
Yeah, no, I
another thing
quite like that.
too with the 1 minute is, if you're trying to look for really early signal of some really quick move, the put premium and call premium are very responsive on the 1 minute.
Yeah.
So I would almost just argue that on the 1 minute, you might, if you could come up with something with the put call ratio, great. But like on the 1 minute, the real value, at least for me, when I'm using the tool, is to look for really early changes in put premium and call premium.
Yes. Well, this example that I'm working through has some of that in it, and me trying to figure out put premium, put call ratio, and skew kind of all together. So, yeah. But I took the screenshots based on 15 minutes, but then the link is there so people could go back and watch the video and watch it come in, but obviously not change the time frames. But on the second one, so there was this sort of V, so it drops down hard and then it V's back up.
Mm-hmm.
So on the second screenshot, there was another 1,000 each of the out of the money puts. The 6,600 was out of the money by then, and then there was also 6,610 puts coming in, which I assume is sold as it's dropping. I'm not really sure, but I assume they were sold. And then Gex is increasing because you've got spot going towards those strikes. And then you can see that the put premium started to rise against the call premium, and the PCR was rising. But then I wanted to ask about the flips converging. Is that just basically is that just a sign of what's going in and out of the money, or is it
Both.
show where things? Yeah,
it's
I kind of
like short puts are closing really really rapidly. Puts are being bought, so you're getting like delta is being added to the downside, and gamma's kind of shifting up because it's such a large move that the market maker's positioning is actually shifting with the drop in spot. And so it tells you a few things. I mean, delta going below gamma is usually really bearish, but contraction between delta and gamma can also be really bearish. And that's because supportive positioning below spot is falling away. Whereas, if you're getting expansion, supportive positioning above that flip point is being added. And so, I mean, you're kind of seeing the flows, but you're seeing how that flow is affecting the neutral point in the market maker's book.
Yeah.
Give me 1 second, JFresh, if you can
sorry.
answer the rest of this. Are you there?
Sorry.
Yeah, I'm here.
Okay, 1 second. I'll be right back. Sorry.
He has to take a huge diarrhea.
I just really on a basic level, I have a lot of trouble. Gherkin a while ago kind of spent the time, like with the gamma, like the Gex curve, and which the G flip's kind of mimicking or trying to mimic with intraday volume. I can kind of picture how the shape of the curve moves as things go in and out of the money, and maybe gamma being added different parts of the curve. But I really have trouble with the delta, whatever the delta equivalent of the Dex curve is. I have trouble understanding, like if a call comes above, or it'd be, I guess, delta's in the money. So if a call comes below, is sold to the market maker below, does that move the flip up or down? Like it's so basic, but it just does my head in. I'm trying to figure that out.
Yeah, no, I think it's
the
fair.
maths and the logic behind that.
I mean, one of the reasons that people don't just show delta is because it's just a hugely sloped line. For like intraday, it's just like a straight line. And if you assume all puts are sold, or sorry, all puts are bought and all calls are sold, it's just like a straight line down. Now, and then the derivative of that is the gamma, which tells you like how it's changing with spot. So what exactly was your question regarding that?
So like with the gamma, or it has a different assumption to the delta. So the delta has the naive assumption, and then the gamma has the gamma, but the gamma assumes that all of it is sold to the market maker, doesn't it? Because otherwise it would all be positive gamma.
No. So yeah, so gamma is a symmetric quantity. So gamma, everything was delta is the one that
and delta's delta's the opposite. Yeah,
they're all so okay. So just think about it this way: they're all naive. They're all naive. The naive is just saying we assume that all calls are sold and all puts are bought. I think the confusion might come from the signs of the delta versus the gamma because they are different, which is confusing. So I like to think when I get turned around on this, I just like to think through examples. If I sell a call to a market maker, I'm short delta, which means they are long delta. So if they are going to hedge that long delta away, they have to sell the underlying. Okay. Mm-hmm. So by me selling a call, they have to sell delta. If I sell them a put, so still selling, but selling a put, they have to buy the put, which means they're negative delta, which means they have to buy the underlying. So selling a put makes them buy delta. So the signs are different. If I sell a call, they sell delta. If I sell a put, they buy delta. So two different things, right?
Yes.
One bearish, one bullish. With gamma, if I sell a call to them, then I am now negative gamma. My position is negative gamma. Their position is positive gamma on the call side. Okay? Mm-hmm. If I sell them a put, I still have negative gamma and they still have positive gamma. So they're the same for gamma. And the way to think about it is this: if I sell a put, the value of that put, or the delta of that put, is going to go it's going to get closer. This is like a negative thing. It goes positive as we go up, right? Because it goes from like -1 if it was in the money to 0 if it's out of the money. So if the spot price goes up, delta on the sold put goes up, right? Does that make sense? It's a
Yes,
little
it does.
confusing, but yeah.
It does, but like,
Because it's
with,
going from -1 to 0. It's going from like really valuable to not valuable, right? So but it's still going up with spot. And so that's why gamma and delta have different signs, whether it's bought or sold. So gamma doesn't care whether it's a call or a put. Delta does. And I could
yes.
probably try
Gamma.
to actually, if you go to the docs, let me find the exact page.
It's the pressure on the actual flip that confuses me, if that makes sense. Like if the market maker has to sell the underlying, sell them a call.
Oh yes.
What
Yeah,
pressure
yeah.
does that put on the flip? That's the bit that I'm like, like, because gamma, I
So
can kind
you're
of
saying if
imagine
I
the
sell a
expert.
call, you're saying if I sell a call to a market maker?
If you sell if you sell the call to the market maker, and then so the market maker has to sell the underlying to balance it. Does that raise?
To balance
Sell
the
it.
delta.
Yeah. Does that increase or decrease the like? I'd go. Does that put pressure down on the like? Does that decrease the delta neutral or D flip, or does it increase it? Like I with
Yeah, so
gamma,
this is a little different. So now we have to think about we're summing up the gamma and delta.
Yes, the sum. Because I can do that with the Gex curve. I just go positive. I just go a flood I just imagine the normal gamma curve adding to the Gex curve, and I can see the pressure that puts on it. So if you add positive Gex to the market maker, it's going to sweep through that gamma curve, and GN goes down or G flip goes down because that whole kind of curve has been lifted up.
Yeah, that
That
actually
bit with D
kind
flip,
of
I
works.
can't get it. I can't visualize it. The netting of it all.
So I think probably the easiest way to think about it is because, and I'm assuming it's because we were having this discussion of like the contraction or expansion between gamma flip and delta flip.
Yeah.
Is that
yeah.
So, I just went on and on and on about the fact that gamma and delta have different signs, right? Gamma doesn't care whether it's a put or a call, but delta does. That's where that contraction comes from. One moves one way and one moves the other way because of that. And so take your intuition for gamma and just flip it basically for delta. At least on the put side.
Okay. The afternoon. I will try to do that. But yeah, I've noticed that them converging and diverging signals some fairly good moves, and people have posted some pretty cool screenshots in the discussions and things. So
yeah, you know what? Early on in this, everyone was just like, "What happens when they flip? Like, or what happens when they cross? Is that like, what does that mean?" I'm like, I don't fucking know. I don't think it means anything. But I think the contraction and expansion is a very real signal that it's telling you that basically something's happening with the puts. Because of that flipped sign between gamma and delta.
Yes. Okay. So I have to I'm going to get my head around that. I'm just such a visual kind of.
Yeah, I'll think about, I'll think about some drawings or some graphs I could create to make this idea a little easier to understand.
Yeah.
Because there's a lot of negatives. It's like I joke with Dork. It's like recursive negatives. There's like, you just have to track so many little negatives for all these little things. And before you know it, you've missed a negative somewhere. And then you're just like, is this right? Or is this the opposite of right?
Yeah. I've often got an opposite. I'll think like it means calls are being sold, like calls are being bought or something. Yeah. But no, if you, I'll try and find the discussion that where Gherk went through the Gex curve, and then I can just see it. Like, it's great because that's just. I'll try and find that that particular Gammastrike and send it to you. If I could have a Delta version of that, that would be amazing. I just can't. I sketch things all the time and I just can't get it. And I'm chatting with AI bots. That's like the blind leading the blind. It's very frustrating.
I don't know if you listened to All Stars, but I think it was episode 8 or 9.
I like your intros.
Thanks. I actually do try to work kind of hard on those. Although some of those don't really, they start in my head like maybe a day or so before, but I don't actually write it down till 5 minutes before we record. So anyway, I think
yes,
I think with the gamma and the delta, the thing with the delta and I mean, you can kind of get a sense. Trying to see if options macro is a good kind of, maybe not really. So we flip. Yeah, I won't go into that.
Okay.
So we basically we have a delta curve.
Oh, okay.
On options macro, the moneyness macro, that middle chart, OI delta value is a function of moneyness. That's technically a delta curve. And so you'll notice that it's sloping down. That purple line is sloping down from like 75 moneyness to 100 or to 97. That negative slope, that's the negative gamma on the gamma curve. And then when it turns positive, that's the flip. And then the maximum is somewhere, at the maximum slope. So you have to take the gamma curve is basically the derivative of this.
Yeah, okay. Because I've been, I'll just post it to chat, but this is the best as far as I got with hours of AI trying to get it to explain to me why delta rises. It's terrible.
I can't.
But yeah,
I
can't get graphs in my head.
Explain how.
I
gave AI.
Yeah.
I gave AI.
That's that hockey
most
stick.
Fighting shot I could have given it, and I almost gave myself AI-induced psychosis because I thought I didn't think I was like solving new physics, but I was like, I'm making headway into this important problem that I need to solve. And it wasn't, it wasn't. And I had to I don't know. I had to just tell myself no more. Stop using it. It was not healthy. I do not recommend it in terms of increasing your understanding. I would say as conversational search may be okay, but you still have to verify the sources, but don't ask it to do the thinking for you. It's going to turn you around in circles.
Yeah, it's
I turn myself around. It's like.
But it's just going to validate. So but that's the problem. If you turn yourself around in circles, it's just going to validate you and spin you faster.
Yeah, true. Yeah. I'll just come up here and.
If you think
I try not to hug the stage too much.
If you think ChatGPT has a hard time counting things, try feeding it a PDE.
my favorite is when I'm like, no, that's wrong. And they're like, you're completely correct. That is totally wrong. And I'm like, oh god.
Every once in a while I'll get it to fight me and be like, I'm not gonna budge on this. You're maybe you're being insightful and clever in the way you're thinking about it, but here's why I'm not gonna change my mind. And that's when you know that it's wrong.
Yeah. So I'm sorry, I know I've been up here for a long time. I'll try and get through the rest of my questions on my as fast as I can. Sorry if anyone's waiting.
You're fine. No one's waiting. Or if they are, they're not raising their hand yet.
Okay.
Yeah, they're all just shit posting. You can keep going.
Okay, cool. So So in this example, I feel like it was a nice example of the flips coming and going, but also the way that I'm trying to find skew in the IV curve, but just not quite getting there. Like in the second, so when as it's dropping, so during the drop, like the puts are coming in, I feel like they're getting sold, but then also like kind of during it and as it's starting to turn around, there was no skew in the IV curve, but it seems to me like that's because the calls started coming into, like people were buying calls like above spot as they were selling calls at the same levels. So I wondered, I just wondered if that's why I'm not seeing them, why there's no really obvious IV skew, except I did notice in the middle drawing that there was a slight kind of dip, like in the middle of the gamma curve has dipped, and at 6610 there was a tiny dip up of IV where I thought maybe that was call buying. I mean, is when you're watching as a trader, you said you're watching those three strikes on the side, is that the level of subtleness that you go, oh yeah, that's buying, or is this too subtle? You're like, that you would still consider this the flat version of the curve?
I mean,
that's what I'm trying to get in my head. Is it subtle or is it
immediately looking at this IV chart, it looks like
Yeah,
the
it's
6585 is being sold really heavily,
Yeah. So
along with
generally
the 80
skewed to
and
the put side.
75.
Yeah, generally skewed to the put side, but with some heavy selling at farther OTM. Or,
Yeah.
you know.
And then it also looks like the 30 call is being bought like crazy.
okay.
If you look,
I guess it's more subtle than I thought it was going to be. Then
it's really fucking.
It
It's
is
really
very
fucking.
subtle.
Yeah, but that's also because it's really fucking hard to move the IV on an at the money strike like that.
Okay.
So
Yeah,
if you
I mean,
see
because think about what it is you're doing, right? You are trying to change the price of the options, which means you have to change like the overall expectations of the market makers for prices over time for the whole market, right? So they are going to be subtle changes, but they are notable, right? So if you start hammering really hard on a specific strike, you're going to start hitting that ask and making the ask go up, which is going to make the IV go up. And so those are the kinds of things, but it's not going to go up. It's not going to go up 20%. Like that would be insane. That market would be impossible to even like comprehend.
that actually happened
they
at
are
the end
very
of the day today.
Oh God.
The middle screenshot, it's got this great big dip up at the 67 at 65.70, and I was like, is that how obvious? But it's not. It's really subtle around the spot, and then it's only the.
Well, you're looking at like a variation between those two strikes of like
really
of like a few points, right? So you know, you might have this strike below spot, right? Let's say, whatever, 60. I'll just use this chart. So 66.20. You have 25, and then you have 30 spots here. What's wild about this is that these two strikes are basically equidistant from spot. But this strike is, let's say, like 25, like 0.253, which is 25.3%. And say this one is 22.2. That's a fucking huge difference. Now, as you get later in the day, that's the spread between those can be wider. But that's very significant. This is like significant buying at that one strike out of the money relative to this. And then the wider that spread gets, the more likely it becomes that this is not only just, there's no buy interest here, but this is probably also being actively sold. And so as that gets sold, that drops, spot stays where it is, and then this rises, and that's where you start to get the shape of your skew. And so, but it's those at the money positions that are changing relative to spot that are determining, you know, the price of further out of the money options. And so that's why I watch those two strikes relative to spot, because the shift in those can be very deterministic in where price is going to go. Because that's where the market maker is saying price is going to go, and they're charging more for those options because they think price is going to go there.
Yeah. You know, but the problem I see, you just said the 65 and 85, 80, 75 and 70 are being sold. All my brain goes is the 68, 90 is higher, that must be being bought. So I also don't have in my head.
Well,
I pick the one that's out of line and I go, oh, that one's being bought.
think of it
Oh,
this. Think of it this way: you have a when you look at your IV smile, in a perfect world, every equidistant strike is going to be priced exactly the same. Okay. And so this is following that curve. I mean, it's a little skewed to the downside, but it's mostly following what you would assume a smile to be. But then you can see that these are obviously, like, this is on track with those. But these are below.
Okay.
That means sold.
Yeah.
And not just sold really heavily.
I've contemplated, and we've talked about this before, just taking the IV curve and also plotting it flipped around spot.
Mm.
Yeah.
So you can see the spread.
So you can make that comparison directly.
Yeah.
I don't know how well it'll work, but
I don't know if it makes that much of a difference.
Yeah, my can't quite see that pattern. Like when you highlight it, I'm like, oh yeah, but it doesn't see it like naturally. I don't know. I know that your work display it. That's really helpful, Ben. And then I have a question, because assuming that, a little third graph, we've had the hard bounce. There's now a lot more puts, is presumably at 6,600 and 6,610, and then we've got the bought calls, I assume, and then I'd assumed, and then if those calls were to take profit, went back and retested 6,600, does that make you go, when you're selling vol, more or less likely, you know, given that there's now more support on the second test of that level, does it make you more or less likely to think about selling the bull put spreads?
I'm usually, well, it depends. On a move like this in a negative gamma environment. So the first thing I'm going to look at here is, is market dealer gamma supportive or not? Like, if the dealer is pro-cyclical or negative gamma environment, selling puts becomes infinitely more dangerous, because the chance of downside continuation on a continuation up in implied vol is way too high. And so immediately you're asking a question about selling vol into rising vol, which is, you know, not a great idea. However, if you look to the right, where the now on the right of the chart, you always have the full day gamma displayed, not relative to the window or bucket you're looking at. It's just the full day. And if you look at that, you can see that even though we dropped really hard, gamma didn't get super, like, total gamma exposure didn't get super negative. It's pretty negative, but it's not that bad. And obviously, the more negative the gamma, the more likely it is to increase volatility. And so, you know, we immediately slipped, like, the kind of minor support there at the 6620 level. And that's kind of what happens in negative gamma environments. Supports just aren't as strong anymore. You kind of like your, I use that gravity example. It's kind of like your rocket ship is going fast, so it doesn't get caught in the orbit of the planets it passes. Um, but finally, there's a big enough planet, and it kind of chops at the bottom, and you start to get a lot of repositioning. Like you can see PC ratio spikes, and the premium starts to turn down, and Dex and Gex start to flatten out. And then on that first test, and I'm seeing the flows that are supportive. I'm seeing the skew in the IV that's supportive. Like everyone's just selling the fuck out of those out of the money puts as hard as they probably can at that moment. Then I'm gonna have a lot of confidence in selling puts on that bottom. On the first test. Now, if this bounce were to fail, like this gets up to mean reverts, gets up to like 66.40, and then we drop right back down again. On that second test, I'm definitely not selling puts.
Okay.
No way in hell. Even if it were to double bottom or what have you, I might consider selling puts if I could confirm that we went back above 66.20. Probably wouldn't sell them in as much size. That first reversal has a lot of momentum baked into it, right? It's got a lot of profit, like panic profit taking. On the put side, it's got a lot of panic put selling on the bull side, and the impetus for it to turn price action around rapidly is much higher. A second test, you're going to bleed down into that. That means people are just, if it fails again, people are starting to actually just position for more downside. They expect vol to continue to rise, price to continue to drop. And then you're betting against, like that second test, you're betting against what everybody now believes to be true in the market. So all the participants are going, this is going to go down. And you're going, no. The first time, no one knew it was going to go down, so everyone freaked out. That's why it bounced so hard. The second time, you're betting against everybody who's now pushed it back down again.
Right. Okay. So is that different if you're in a positive gamma environment? Like if you keep hitting resistance to the upside over and over and over again, does that make that resistance
It depends
stronger,
on,
or is it the same situation?
it depends on how positive the gamma is and how far price pulls back from that test. I mean, obviously in a positive gamma environment, when you test an upside resistance, you don't sell off like super hard like you would in a negative gamma environment. You sell off a little bit, and the market maker comes in to support that sell off. They buy into the falling price, and price pushes back up. So price is far more mean reverting, and this is what causes pinning. And the more positive gamma you have, the more of a pinning effect you have, because the market maker is buying those drops more strongly. And so not necessarily. I mean, large failures in positive gamma environments are rare. They're an unlikely event, and they actually generally have more to do with overcrowding. People have sold the market maker so many puts near spot that when the price drops, the market maker just squeezes them all out. And that's generally the kind of like actual failure you get in a positive gamma environment. And generally those failures occur when that supportive put selling is breached. So they'll sell those puts all the way down to a test of those puts. But if those puts start to go in the money, then the market maker starts to squeeze those people out and they start to panic buy their puts back. And that causes the price of the market to drop really fast. But that's like a rare instance where the market maker has become overexposed to those short puts and they're long the implied vol, and so they have every reason to let all those positions collapse because people sold them to them for less than they have to buy them back for. So the market makers making a bunch of money. They're very happy about that.
Mhm.
But otherwise, if you're getting persistent upside tests, especially if support continues to rise, gamma below spot continues to rise, there's obviously like a lot of positioning both coming in supportive to the downside and long to the upside, then those multiple tests of the upside resistance are likely to see that resistance broken. And that's why you kind of get that stair step price action, because price can't really fall very much. But when it moves up really quickly because the is selling into that move up. And so what you end up with is like a breakout where things reposition and the has to account for the new strike going in the money and the shift in implied vol. But then immediately the market maker starts selling into that upside. And so you get you'll get like a $5 leg up, and then price action will flatten out again. And you'll keep getting that stair step in positive gamma environments, whereas negative, you just get down, more down, or you get up, up until you've mean reverted back to where things are more neutral.
Yeah. So I wanted to ask about that. The question I've got against this bottom slide is that where we assume the positive gamma range is, like you've got the gamma neutrals, and as you get kind of more and more is closer to expiry, like we go off the gamma flip on the intraday instead of the gamma neutrals to assume where perhaps it's negative gamma versus positive gamma.
Yeah, the gamma flip is definitely more important into the end of day for zero DTs than the whatever local gamma neutrals there are.
Yeah,
because those are those gamma neutrals full chain, and it's like OI based, and so yeah, I mean the zero DTE gamma right at expiration blows everything else out of the water.
And so based on that as well, because people reposition during the day, but that gamma flip is based on the OI for the whole day, I assume.
The gamma flip is based on the intraday volume.
Yeah. So like on the screenshot on the bottom, you've got the 15-minute sort of GEX curve sort of there. And then that kind of shows perhaps where there's positive GEX and negative GEX. And my question is, at some point, perhaps it's actually lower if positions have closed and repositioned. I don't know how to say that. But
try asking that a different way. I'm not sure where you're.
So if you've got positive GEX, like where spot is in that bottom chart is positive GEX, but we're below GEX.
Yes. Well, that part of that's your That's your window.
Yes, the window. Yes.
Yeah. So the flips don't change based on the window; they're based on the whole day.
Yes, but a lot of that positioning might have closed and repositioned. So I suppose I'm trying to say, is it like GM to G flip is like G flip to shorter time frame GEX curve? Like, could it possibly be that you're in positive GEX even though you're below gamma flip?
I mean, well, you can just look at where GEX is, and that tells you where overall exposure is. What you're seeing on the 15-minute window is that there has been positive gamma coming in over the last 15 minutes nearer spot, but that positive gamma that you're seeing in that 15-minute window has not yet moved total gamma exposure positive, which happens once you get above the gamma flip.
Yeah. So you're kind of you do use the gamma flip, not the larger time frame GEX curves. I suppose is what I'm trying to say.
I mean, I use both.
Yeah.
Because I want to see what's happening with near-term price action, but I also want to see where overall positioning is for the day, and that's why That's why one of them isn't windowed and one is. Because one is designed to let you see the near-term price action and changes in positioning, and one is there to tell you where the overall positioning is. Both of
Yeah,
those
no, that
being
makes sense.
very, very important.
Okay, cool. Thanks so much. I can see potatoes up here, so
Potatoes next on deck.
yes, exactly. Yeah, I'm going to take over. Thank you so much.
You're welcome.
Bye.
Thanks for coming up, B-Watts. It's always good to have you.
Yep. All right, potato.
Are you playing
got
Cookie
big-
Clicker again, JFresh?
No, I'm shit posting on Twitter.
Oh, okay. You didn't even
Hello, but not.
repost the roundtable.
My brother, I had a long day today.
I know, it's all right. What's up, Potato?
Here now.
Hello. So I just sent a screenshot. I tried to like consolidate, I think, my thoughts in terms of like how I interpret the graphs using, again, like all the documentation and kind of going through like previous roundtables. Again, I'm still trying to consolidate it in my head.
Okay.
Yeah, so let me just open this up on my screen because on Discord it looks really, or however you pulled it up, looks a bit small. Give me a sec.
I can zoom in on it.
Yeah, so I took this one, I think, on the 27th. And basically, I was trying to look at this graph and figure out Gamma Max dropped sharply, like I think by $10. Delta neutral, Gamma neutral stayed relatively flat.
Looks like it was on the 23rd or 25th.
Yeah, from 21st to 25th.
Okay.
Basically.
Yeah.
So I guess I'm trying to understand, like, there's quite a few changes. And where the hell am I? Oh, there's my notes. So looking at all those observations, skew adjusted, delta exposure, diverging, I'm assuming that means it's more bullish because it's making the naive assumption less correct, if that's my understanding.
Wait, are you saying the skew adjusted is telling you that the naive assumption is less correct?
Yes.
Okay. Yeah.
And then gamma exposure is becoming more positive, going from negative 3.1 billion to 788 million.
Yeah.
So those are just kind of things I was trying to just, again, find a few points and just try to make sense of it. Again, because there's just so much info, and I'm still also learning all of this. So when Gamma Max drops but DNGN stays flat, what does that mean?
I mean,
Like, what can you infer from that?
So one of two things: people are buying to close out of the money calls, or people are buying out of the money calls. I mean, I guess in both instances they're buying them, but you're getting a lot of out of the money call activity. So Gamma above spot is growing, but it's not growing where the peak was. It's growing below where the peak was. So the prior peak of Gamma and the prior high was obviously, much higher here. It was, up here around like 650 back here, right? And then as that drops, we're seeing, like, you can kind of see the point where it starts to drop. That's that Gamma, that's that peak of Gamma shifting lower, right? And then it sells off again. So spot's moving away from that peak, and then, those options are closing. And so the peak of Gamma is moving further out away from spot. And here the peak of Gamma is contracting again, which, met with this reversal. And so, yeah, you're seeing out of the money positioning that's adding Gamma in those ranges. And since Gamma Max is not a neutral point, technically it's a maximum. You're seeing where the market is positioning for the price of the market to go at its peak. So if you see Gamma Max fall and prices down, that means that people are positioning for an out of the money target that is above spot, and they're probably loading up a lot of gamma in that range, and that's why gamma max is pulling down so fast.
Okay.
Yeah, and then I'll just add in terms of the DEXA. I mean, it ended up telling you about what you might have expected if you just look historically. It's unlikely that it would have gone much higher than it was, and it flattened out. So the flattening out doesn't mean no more up. It just means much more muted up, right? Because up is the default position. But it definitely showed that, hey, we're kind of topping out the range of volatility. We're gonna start getting grindy.
Okay. I see. Got it. Versus just the straight up, where now it's just more flat. Okay.
And you can also
And
look too, like I'll tell you this. I cannot tell you how many times I've been in a bearish position and thought we're kind of maxing out, like bottoming out on the DEXA. But this time's different. We're gonna keep going. This is it. This is the one. And then we just fucking bounce. And so DEXA is also equally great at showing you kind of where your downside range is.
okay. And then
I'm
again, I
actually
think,
a huge fan of DEXA. It's one of the most valuable things I ever made.
and then I guess on the opposite side, or the other part for Gexa, so with that becoming more negative, there's more
I will say this
option
about
buying,
this, since I
or
also made this. I have found much more value just from Gex than Gexa. I'm still not quite sure what I'm actually gleaning from Gexa, other than
Voma?
what Dex is telling me, which is, or what Dex is telling me, which is people are aping into more and more options than ever before. So I would say for now, like for Gex, focus on just the Gex, because that I think is what, again, this goes back to something I mentioned before. Sometimes you just have to let go and acknowledge the fact that there are a lot of other traders that are trading these similar signals. There are many more traders trading Gex than there are Gexa.
okay.
And so I personally regard Gex as being much more signal-y than Gexa.
Yeah.
Dexa, I have gone against Dexa probably 20 times in the last 2 years, and I have been wrong every single time.
Okay, so just try to have more of a focus on Dexa and Gex, really, compared to Dex and Gexa.
Yeah, just remember that that relationship with implied volatility to gamma is inverse. So when you're looking at equities versus indexes, just keep that flip in mind. Like equity volatility goes up to the upside, index volatility goes up to the downside.
Oh, okay, yes, because that would make an impact.
Yep.
Okay, okay.
There's a follow-up, if it's okay, really quick, although you still have the floor afterwards, because this person is too much of a coward to ask in person. But how do you determine when Dexa is bottoming out? Looks obvious in hindsight, but how in real? Yeah, were you the one that didn't have a mic like 6 months ago? You couldn't figure out that $20? Yeah.
He also doesn't own a cell phone.
Oh, weird.
Yeah,
So you're
well,
one
you
of
know,
those people.
Pigeon Whale's not cheap, so let's not judge, okay?
Okay, that's fair. I won't judge.
Thank you.
Yeah, that's a good point. Like, when is it bottoming out? It's hard to see in hindsight. Is it though? I mean, one of the great things about it is that like it gets to like within 30% of decks.
Fuck that, just
Like
buy the
it's actually
like I just long the reversal in it. Like just confirm it, like any other technical signal. You can just confirm it. You don't have to like nail the bottom of every trade.
yeah.
I mean, you will sometimes, but you don't have to do that. You can just
But like on
confirm
this
that it's turned
but
around.
like on this last one, like just looking at the last one, even if you didn't nail the bottom, let's say you just like bought the new low of the month. Like you would have been sad for a couple days, but
Hours.
then you just dick rocketed right back.
Theta. That's the
You're up.
problem.
But so if you bought the new bottom, which wasn't, or sorry, if you bought the new low, which wasn't even the bottom, it continued to go down. You're going from like 604, 603 to 623 in like 5 days. What's the deal? Honestly, I am stubborn, and I'm so stubborn that I've literally looked at this indicator for 2 years and said, this is what I want to happen, but this is what this is telling me it's going to happen. And I say, no, it must be wrong because I am smart. And it's
No,
literally
you're
been 2 years, and
you're
I've been
you're just
wrong every single fucking time.
you're
Every
just
single time.
you're just bearish as fuck.
100% wrong. Yeah. Like, if I was going to actually just shape up and admit that and be humble and admit that I'm an idiot, I would trade this. I would trade Dexa. Hands down.
No, yeah, thank you. I think that's all the questions I had. I think I'm still formulating my understanding. I think like the docs are awesome. There's just a lot of material to go through. And then I think there was one of the roundtables where it may have been UJ Fresh or Gherk, but like you're saying, you're trying to infer based on so many different data points and like what they mean or what sort of conclusion you're coming to.
Well, yeah,
And
I
again, I
mean
guess
that's kind of the beauty of the tool we've built here is that you can look at it from multiple angles and determine how right your conclusion is, and
Mhm.
like I specifically I didn't buy this bounce until we went over delta neutral. So not only did I wait for the confirm in Dexa turning around, but I just waited till we got over delta neutral, and then I went long like 30 days and sold some like 10-day puts because they were overpriced. And admittedly, I got stopped out right around the gamma neutral, but that was still, like a $15 move.
Yeah.
So, I mean, nothing to actually complain about. Just
I'm telling you, if I just don't have time and I'm too stubborn, but if I ever like shape up and like trading's going to be my thing, I'm trading Dexa without question. Cheese Steez wants to add on. So the gap between Dex and Dexa right now looks bearish. Okay, so take your attention to the time period from like May 25 to September of 25. It just goes up. So
Yeah.
what high Dexa, like historically high Dexa tells you is low vol. Up low vol.
Mhm.
What low Dexa tells you is we gonna bounce at some point. Now that
Yeah.
bounce could take a little while, right? If you look at like March to April, right?
Yeah.
That was rough, but it came back, right?
Yeah.
Kind of same thing with August. Well, no, not really. I mean, it had great volatility there. You had really good ups and downs. So yeah. So I guess if the market crashes, you might have to wait an extra 3 weeks.
No, there's
Um,
hold on. It depends on the type of event, right? If it's
2022 is a little
you have
harder,
volatility events, in which case, yes, the market's going to bounce right back. But then you have like systemic and macro events where the market does not come back. So you have to be very careful about which type of crash you're seeing. And we technically did crash
and
in
we
March.
haven't had a systemic crash since 2000. So, good luck.
Yeah. Even that was immediately turned around by the Fed. So
Sure,
they
but I would
turned
say
a systemic crash into a volatility crash by pumping the market full of money.
yeah, and I don't have color into 2008. I mean, they weren't even most options were traded on the floor back then, so we don't even have like access to that data, nor was it that large.
Yeah, it was significantly smaller.
But I can tell you from like pretty much from 2016 to now, we haven't had a real crash. Because a real crash would imply a drop in leverage or a drop in, value. But all these other crashes, all they were was they just flipped value from calls to puts. Like nobody closed out. Money just switched hands. It was a volatility event. It was not a deleveraging event.
Yeah.
And so, yeah, we
Although
haven't seen one.
I will say
since.
we came very close to deleveraging in March. And if Trump hadn't tacoed, we probably would have.
No, I think that's true. But yeah, he was able to save it before there was literally, I mean, maybe a little bit of a deleverage, 100 billion ish, but then it just popped right back on. It's harder than ever the second he tacoed. So it's not like they were really like closed out. They just exited momentarily because they were bearish.
I will say something
So
about bullish markets that you can see on DEXA here. And that's in bullish markets, DEXA will continue to trend. And so the current situation where DEXA is flat is a little bit of a warning. Can be a little bit of a warning. Now, obviously, we have a bunch of data coming up that'll probably determine which way it breaks, but it's pretty rare for bulls to let things sit. There's nothing bulls hate more than 1% down days, and the thing they hate most next to that is buying calls and then not having them immediately print. If bulls ever face either of those situations, their entire portfolio blows up and they have no idea what to do. So the fact that bulls aren't buying more, like options aren't becoming more bought here, is kind of a warning signal.
Yeah, it's hard to predict when down, but it's. I mean, we've had what six trading days of straight chop in the same range.
I mean, you'll see
with a fair amount of intraday volatility.
If you look back over time, you'll see very few instances where the market doesn't sell off after DEXA goes flat. Like either DEXA continues to trend up slightly higher, or it goes flat and it fails. Even if it's just a small pullback, it'll be a pullback. You know, like here in March, it's flat for like 4 or 5 days and then dump. They don't like to sit on long positions. Nobody does. Nobody likes to have a lot of theta on long positions. And instances where being long gamma are pretty rare. I mean, we're kind of in one right now, but they're not very common. Usually you have a very clear benefit to, you know, one position or the other. And so yeah, generally anytime you get flatness, the market will sell off because the market's not going up. And if stocks don't go up, then why are people buying them? And I'm not kidding. I know it sounds stupid, but it's actually true.
And then I did have just a follow-up question. I think when I joined, it was Nuke maybe that asked something. This is a bit different, but when you have like your stream for the live, what do you call it, the live trading, if you have a bar, let's say like a delta bar that's negative and it's starting to flip, I think he was talking about this, is starting to flip into positive delta, like at spot. If IV is going up, is the assumption safe to say that calls are being bought, which would cause more buying? Where if it was the opposite, if people were selling more calls, delta would still be positive, but IV would be going down.
Correct.
And then they'd be selling into upward pressure.
Yeah,
Okay.
I mean, honestly, on a breakout, call premium on the new live data is a great way to just tell if people are selling calls. Because if you're looking at like the 5 or 15-minute window and you're kind of trading flat and just chopping and you're getting a lot of like distribution, if call premium starts to fall, and then especially if put call ratio starts to fall behind that, you're probably getting an overabundance of sold calls. And you know, as a trader, you don't actually, it doesn't, and this is one of the problems I have with like bot sold metrics versus the naive assumptions that we use, is that, you know, naive is a clear calculation in all situations. It's going to be the same. Whereas when you start getting into the realm of like bot solds, you start to create a lot of unnecessary opaqueness, right? Because, you know, everyone's got their own formula for how to figure out bot sold, and then some of those are better than others, and you don't know what the performance of that, you know, is, and you don't know the correctness of that assumption that's being drawn blindly without your knowledge. And so with naive, you know, you don't, and this is why, yeah, this, now I'm going to circle back to that. With naive, you know, the assumption's already made for you, so you don't need to worry about if those options are being bought to close or bought to open, or if they're being, you know, sold or sorry, sold or bought to close, or, you know, you don't care how they're closing, just that, you know, the premium on them is declining because, you know, the bid's getting hit. You don't care what side of the book that's happening on, because both have the same effect, and, you know, price being more and more likely to come down.
Okay, so bot to, sorry, I think I'm trying to wrap my head around that.
So if you see that premium falling, you know, the basically, you know, someone's selling calls, but you don't care how they're selling them. You don't care if they're selling them to open or selling them to close. They're selling them. So as a trader, all you care about is, does this make price go down? Yes. And then
I see. Okay.
like, and so like, but you know, if you're trying to look at it 3-dimensionally, and you're like, well, you know, some of those are being bought to open. There's some being like, you know, sold to close. There's some being sold to open, and then you're actually creating more confusion in what you need to read, which is the signal that, you know, shit's getting bearish and you should probably not be long anymore. Doesn't mean you should be short, but you probably don't want to be long anymore because the value of the options you're holding long is dropping.
Yeah. Okay. I see. Yeah, because if you start going into the third part there, yeah, I see what you mean.
It just starts to add like a lot of multivariate states that you don't need to know about. They don't matter because you're not making a book. You're just trying to make money.
Okay, got it. Okay, I think that makes sense. Thank you. And then again, the documentation's awesome. I think I have that open for so long.
I think we just did a big update on it too, if I'm not mistaken.
Well, it's not a big update, but it's some of the tools have been updated to match the.
I love how you show up to gain your praise.
I've been here a while. I was letting you talk.
All right.
I get
And
you guys complain all the time that I never shut the fuck up, and then I shut the fuck up and you give me shit.
and then just the last question I had, I think, was for non-beta users. Is there like a timeline for like version 2?
So yeah, actually there is, and I want to apologize to everybody who's kind of been waiting for it to come out. We got it loaded up into prod and we got it all ready to go, and we got the front end polish kind of slapped on there, and we had a problem with the caching, and that was only with like, the 100 beta users, 150 beta users we have, and so we had to basically go in and like redesign the entire infrastructure in the cache, and nukes.
No, well, hold on. Let's not put too much of the blame on us. I think we can squarely say, without going into too much detail, Microsoft has trouble with memory,
Yeah.
which I think we're all familiar with. The recent story that came out where they're like preloading the file explorer for some reason because it's too slow. So yeah, we ran into an issue where there is a memory allocation problem with a deployment of a certain tool that is unique to Microsoft, and it's not something that we can just fix. And so it's basically taking our memory while we're using it in the intraday and not giving it back to us when we tell it to, because there's an issue with the way that they created it. So we're switching to something else.
Yeah.
And yeah, the something else should fix it. It's basically a different version of the tools that we're using, and we're hoping that memory management is better on Azure, but we're kind of we'll see. We're gonna find out literally
Tomorrow.
in days. So, yeah.
So I'm
No,
guessing.
I was just curious. Yeah.
Yeah, I'm guessing if everything runs smooth and we no longer run into the memory allocation issues, straight out to production for everybody.
Oh, sweet. Okay.
So hopefully very soon. I think we've solved most of the problem. But had we stayed with the prior service, we would have had to have slowed everything down substantially from where it is currently. Your 10-second updates are extremely memory intensive, and so
it would just suck because we wouldn't be slowing it down because of an actual limitation of compute and cost. It would just be because Microsoft isn't managing memory correctly and not giving it back to us when we tell it, kill this memory and give it back to us. We're basically just like fragmenting our memory because it wouldn't deallocate and reassign. It's really frustrating. And there's a simple solution.
Yeah.
Just get them to not do that.
I mean,
we have another thing where they claim that they're not doing that. So
we converted midday today during the stream, and the conversion over to the new system was seamless, and it worked all the way until the end of the day perfectly. So hopefully we're just right there, ready to push it out to everybody.
Yeah, hopefully the transition is painless, but you never know with the transition. I don't want to make a promise that we might run into like a 5-day headache that we weren't anticipating, but we know what the problem is and we know what the solution is, and as long as like nothing else shows up that shouldn't be there, because the original problem that we had already shouldn't have been a problem if Microsoft was doing their job, it should be fine.
There goes our Microsoft sponsorship. Shit.
Satya Nadella, you can suck my balls.
I was going to have him put Copilot into GS.
After my Taco Bell rant.
Thanks for coming up, Potato.
Thank you both.
Did you see my beautiful
Microsoft
Copilot agent? Yeah, you were there for it.
I
just rewrote it up. Yeah. It was glorious.
All right,
yeah,
who's
had my first agentic experience.
Who's shutting us down tonight? Let's see a hand. Willie? Is it going to be Willie? Willie's, I see him right there. I want to see them. He's
going to find a way to keep us up here for another hour.
Way to treat me like a piece of meat, Cheese Tees. Where's Dork?
is
Dork
apparently
is
caring gently
fucking
for
off.
broccoli.
No, Dork
The
is
last thing he
fucked
said
off
was,
and left us.
I'm cultivating this broccoli, and then we never heard from him again. None of us.
No, he left. Not only did he leave the conversation, he left entirely.
He's off cultivating broccoli. He's a broccoli enjoyer.
We should get him some broccoli hair for the pod.
I'm gonna go broccoli hair for our annual meeting next year.
Oh yes. Are you gonna get the fade? Like just pure
Obviously.
fade into broccoli top.
Yeah.
Fucking ginger broccoli. Everybody's gonna touch your head. I hope you know that.
Which one?
All right. Someone raise their hand in 5, 4, 3, 2. All right. Baby Farms.
Baby Farms.
Have a good night, everybody. Thanks for tuning in. And check us out at gammastrike.com.